Welcome to our channel. Today, we're diving into the 20 most common stock market mistakes that investors make and how you can avoid them. Whether you're just starting out or you've been investing for a while, listen up, because these mistakes can cost you thousands or even millions of dollars. Let's get started. Look, I get it. Researching stocks can seem about as exciting as watching paint dry. It's tedious, time-consuming, and often feels like a chore. But skipping this crucial step is like playing poker and going all in without even looking at your cards. It's a gamble, and not the good kind. I once knew this guy, let's call him John. John was always looking for the next big thing, the quick win. One day John heard about this hot penny stock from a friend and dumped $10,000 into it without doing any research. He was convinced it was a sure thing. Turns out the company was a total scam and John lost everything. His $10,000 vanished overnight. Don't be like John. Always do your homework before investing. The stock market is a roller coaster of emotions, but letting your emotions dictate your investment decisions is like trying to steer a yacht in a hurricane. Fear might make you sell everything at the first sign of a dip, missing out on potential gains. Greed can lead you to make impulsive decisions, buying into hyped-up stocks without considering the risks. Remember, logic, not emotion, should be your co-pilot in the market. Financial experts always talk about diversification, and for good reason. Imagine you put all your money into a single stock, even if it's a blue-chip company. What happens if something unexpected occurs? Your entire investment is at risk. By spreading your investments across different asset classes and sectors, you're creating a safety net for your portfolio. Diversification is key. Wouldn't it be amazing if we could predict exactly when the market would go up or down? But here's the cold, hard truth. Timing the market consistently is nearly impossible. Even seasoned financial experts will tell you, it's nearly impossible to consistently predict market highs and lows. Trying to time the market often leads to buying high and selling low, the exact opposite of what you want to do. Let's talk about something crucial: fees. Those seemingly insignificant numbers can eat into your returns over time like termites in a wooden house. We're talking about trading commissions, expense ratios on mutual funds and ETFs, and even account maintenance fees. If you're paying 2% in fees each year, your real return is only 5%. That 2% difference can add up to tens of thousands of dollars over your investing lifetime. You see a stock that's been skyrocketing, and you feel like you're missing out on the next Amazon or Tesla, but past performance is not a guarantee of future returns. Chasing performance is one of the surest ways to lose money in the stock market. Instead of getting caught up in the hype, focus on understanding the fundamentals of a company. Look at their financials, their management team, their competitive landscape. We live in a 24/7 news cycle where headlines scream at us from our phones, computers, and TVs. Making impulsive investment decisions based on short-term news or market events is like trying to navigate a minefield blindfolded. It's easy to get caught up in the emotional roller coaster of the news cycle, but remember, the market is forward-looking. Instead of reacting to every headline, focus on your long-term investment strategy. Stay the course. We all dream of becoming millionaires overnight, but building wealth takes time, patience, and a healthy dose of realism. Setting unrealistic expectations for your investments is like expecting to run a marathon without any training. If you go in expecting to double your money every year, you're setting yourself up for disappointment and potentially some bad decisions. Remember, slow and steady wins the race. Imagine setting off on a road trip without a map or a destination. Investing without a plan is a lot like that. A solid investment plan should outline your financial goals, your risk tolerance, your time horizon, and your asset allocation. It's like having a financial roadmap that guides your decisions and helps you stay on track. Without a plan, you're more likely to make emotional decisions and fall short of your financial goals. Risk tolerance is like your personal comfort level with the ups and downs of the market. Some people are fine with high-risk, high-reward investments, while others prefer a more conservative approach. The key is to find what works for you and to invest accordingly. If you're constantly stressed about your investments, you're more likely to make emotional decisions. Know your limits. You buy a stock, and it starts to go down. But instead of cutting your losses, you hold on, hoping it will rebound. You become emotionally attached to the investment, convincing yourself that it's only a matter of time before it turns around. This is called holding on for dear life, and it's a recipe for disaster. Sometimes you have to cut your losses and move on. Learn from your mistakes. In the world of investing, patience is a virtue. Frequent trading is like trying to put out a fire with gasoline. Every time you buy or sell a stock, you incur transaction costs. And the more you trade, the more those costs add up, eating into your potential profits. Remember, investing is a marathon, not a sprint. The financial markets are constantly evolving. New technologies emerge, industries rise and fall, and global events can shift the landscape in an instant. Ignoring these changes is like trying to navigate a maze with a blindfold on. Stay informed about economic conditions, interest rates, inflation, and geopolitical events. Knowledge is power in the stock market. It's great to be confident in your abilities, but overconfidence can be a recipe for disaster in the stock market. Overconfidence can lead to excessive risk-taking, poor decision-making, and significant losses. Remember, even the most successful investors make mistakes. Stay humble and always be willing to learn and adapt. Remember that asset allocation we talked about earlier? Well, it's not a set it and forget it kind of thing. Over time, as your investments perform differently, your portfolio can drift from its target allocation. Rebalancing involves periodically selling some of your winners and buying more of your losers to bring your portfolio back in line. Keep your portfolio in check. Dividends are like the silent heroes of the investing world. They can provide a steady stream of income and help you build wealth over time. When a company pays a dividend, you're essentially getting paid to own a piece of that company. Reinvest those dividends to benefit from the power of compounding. You're at a party, and someone starts talking about this hot stock tip they got from a friend. They swear it's going to the moon, and you're tempted to throw your money at it. Don't do it. Investing based on tips is like playing roulette. You're essentially gambling with your hard-earned money. If it sounds too good to be true, it probably is. Financial statements are like the report cards for companies. They provide valuable insights into a company's financial health, performance, and future prospects. Ignoring them is like buying a house without getting an inspection. You need to understand key financial metrics like revenue, earnings, debt levels, and cash flow to make informed investment decisions. Knowledge is power in the stock market. In the world of investing, patience is a virtue. Focusing only on short-term gains is like trying to grow a redwood tree in a pot. Long-term investing allows you to take advantage of the power of compounding, ride out market fluctuations, and potentially achieve significant wealth over time. Don't miss the forest for the trees. Slow and steady wins the race. Everyone makes mistakes, especially in the stock market. It's a volatile environment where even seasoned investors can falter. The key is to learn from those mistakes and not let them derail your long-term financial goals. Mistakes are inevitable, but they can be valuable learning experiences. Failing to learn from your mistakes is like repeating the same grade over and over again. It's a cycle that can be broken with careful analysis and reflection. Take the time to analyze your past investment decisions, both good and bad. Reflect on the circumstances and the choices you made. Identify what worked well, what didn't, and why. Understanding these factors can help you avoid similar pitfalls in the future. Use this knowledge to refine your investment strategy and improve your decision-making process. Continuous learning and adaptation are crucial for long-term success in the stock market. So there you have it, the 20 most common stock market mistakes to avoid. We hope this comprehensive guide has provided you with valuable insights and practical tips to steer clear of these errors. By being aware of these pitfalls, you can significantly improve your investment strategy and increase your chances of success. Knowledge is power, and understanding these common mistakes can make a big difference in your financial journey. Remember, investing is a journey, not a destination. It's about making informed decisions and staying committed to your financial goals over time. There will be ups and downs, but by staying disciplined and focused on your long-term goals, you can achieve financial freedom. Patience and perseverance are key to navigating the volatile world of investing. Thanks for watching, and don't forget to like, comment, and subscribe for more insightful videos. Your support helps us continue to provide valuable content to help you on your investment journey.